So welcome to our lesson for today. We are dealing with this paper of August 2024. Now question number 24. And the question reads that as an audit senior at Herufi Audit Firm, you have been made responsible for planning the audit of Reed Team Manufacturing for the year ending that 1st of December 2023. Below is a summary of key information about Lead Team Manufacturing Limited. So we have been given the revenue, the net income, the total assets, the inventory, the accounts receivables. The accountant at Lead Team has further provided with you the following list of account balances as at that 1st of December 2023. So we are given all these balances, as you can see them, all this. Then we are told, number one, is that 1st of December 2023, accounts receivable balance included 250,000 due from a customer who has been declared bankrupt, while accounts payable was found to have been overstated by shillings 150,000. The allowances for doubtful debts is to be adjusted to 3% of the accounts receivable as at that 1st of December 2023. As at that 1st of December 2023, there were prepayments of shillings 50,000 and shillings 75,000 towards administrative and advertisement expenses, respectively. For the same period, there was an accrued amount of shillings 120,000 towards audit fees. The company paid the due interest on the long-term debt on 7th of January 2024. Depreciation is provided as follows. Building 5% per annum on cost, machinery 10% per annum on reducing balance. The company annual general meeting resolved that preference dividend be paid, a dividend of 11% on ordinary shares be paid, shillings 3 million be transferred to general reserves. Number 7, the company maintains a gross profit margin of 25%. Number 8, having been made aware of the significant changes in the ERP system, the CFO position and the business routes, you are concerned about the materiality assessment of the audit. Okay, now you are required. Determine the planning materiality for the audit based on the revenue, net income, and total assets. Justify your choice of the basis and the percentage used. Now prepare the original adjustments and adjusted trial balance with debit and credit columns, each 6 columns. Good. So when you are given that kind of situation, you know we have been saying you start by typing the solution here. You type the solution, make it bold. Then we are told part A to determine the planning materiality. Now, when we talk about planning materiality, it is about getting the threshold within which we'll be sure that there will be no misstatements. It is like coming up with a range. It's coming up with a range that we are sure if we find our values within here, it is okay. If it is outside here, it raises concerns. Now, in auditing, there are various international auditing standards or standards of auditing, and they guide how these things should be done. Now, in regard to materiality, we have ISA 320. That's the one that guides materiality. So when they tell us we use or we justify our choice, of the percentage that we are going to use, we are going to say we will rely on the guidance of ISA 320. ISA 320. Yeah, that's the one that we shall rely on. The other thing is that this is a manufacturing company. This is a manufacturing company. A manufacturing company and would therefore be concerned with the profits made. Yeah. With the profits made. Would therefore be concerned with the profits made. Okay, now, according to ISA 320, the planning materiality, will be designed as follows. Sorry. Will be designed as follows. Now, the examiner wants you to get revenue, net income, and total assets. So we will have the item here. In the item, we will have the revenue. I want to make it, I want to change this. Let me first of all design this other side, because we will have the materiality range. Materiality range in percentages. I want to merge these two. So we have the lower and we have the upper. Okay. For this one, I merge it into 4. Then here, let me design how I want it to look like. So these two, I merge them. And these two, I merge them. So percentages, so these are percentages, amounts. So we also have the rower and we have the upper. So here we will say we'll have the comment. Comment. And here we will have we'll have I want to say what will be material if greater than the material. I want to design those workings. So this one, let me first of all return the merge. So material, or rather immaterial, is less than, yeah, is greater than. Yeah, that's what I wanted. Material. Yeah. So we have these three items. So I can just copy these ones. These ones. They are the ones that the examiner has asked. So I'll come and paste them here. So this one I move. This one I can merge. And then I put up here and left. I can merge these ones. Then I can put borders here. Yeah. So I wanted to design something like that. Oh, I've forgotten to put this one. Yeah. So according to this ISA 320, when you are dealing with revenue should be 0.5. So if I want it to be, I think that is how it should be, 0.05. And the upper value for the revenue should be 1. So 0.01. So I think then here I need to add, a 0 that way. Then for the net income, according to this one, it should be 5%. And the upper limit should be 10%. For the total assets, according to this standard, it should be 1% and 2%. So these values, we can convert them to percentages. And I want them to have decimals. Yeah. So this one, 5%, 10%, yeah. So those are the values that have been recommended. They have been recommended by ISA 320. So if I want to know the amount now, according to what we have been given here, I'll just say equals, I take this percent, this one here, times, I go up there. So this one is for the revenue. So the revenue that I've been given is this one. And because they are following each other, let me confirm that they are following each other. I can just autofill. And that will work that way. I can just autofill. So that this one is the 77 multiplied by that. Higher. For the upper limits, you do the same. For the upper limits, you do the same. For the upper limits, you do the same. You take this upper value here times the same amount here. This one here. So you press enter. So in other words, you're saying if something is less than this, we will take it to be material. But if it's greater than the upper limit, it will be taken to be material. Similarly, when we get a figure and we find for the net income, something less than this, 725, that would be immaterial. But if we find it is greater than this, that will be material. Similarly, when you're analyzing the total assets, if you find something less than that, it is going to be material. But ikipita this 1700, that will be material. So that is the limit that we are going to set as we do audit. When we look at revenues, if we find something greater than 750, that is material. If it is less than, we can just ignore. It will not impact on the decision. And the same thing happens here. So I think that is okay. Higher. From there now, let us go to prepare the adjusted. We can just call it the audit schedule. Let's just call it the audit schedule. Let's just call it the audit schedule. And this audit schedule, obviously we will have the details here. This has become one of our mainstay questions. And the examiner says we should have the original adjustments, the adjustments. They should be original trial balance, adjustments, and the adjusted trial balance. So here, these two here, if I merge them, then I also come and merge these two here. And I also come and merge these two here. Now here, it is the original trial balance. Original, for the interest of space, let me just put it that way, original TB. Then adjustments. Then I will have the adjusted trial balance. Now I have the debit. I have the credit. Then I have the debit. And I have the credit. I have the debit, and I have the credit. That's what you're told to do. And the amount in shillings should be this one. These ones. And I can copy all of them up to that point. Oh, why are they not giving me? Uh, equals. Oh, it's taking a bigger space. Okay, Duke. Uh-huh. I have a bigger space. Okay. I don't want to interfere with my space. Let me see. Equals. It's taking the same thing. Mhm. Okay. Okay. I don't want to take a lot of space that I'm not able to see. So what I will do, this one, I will reduce it here. See everything. Okay. So these ones I can make them bold. Okay. Higher. Now, the next thing now is to bring these items here. So we will copy these ones. We just copy them the way they are. Let's just copy them the way they are. Just the way they are. We copy. We come and paste them here. That's what we normally do. Then we copy these ones here. We copy. Then we paste them here. So that we are now able to decide who belongs where. Who belongs where. Hope you are there. and merge up to here. Okay, so let's now decide who belongs where. Accounts receivable, that's a liability, and therefore it should have a credit balance. It's a liability, it should have a credit balance. So tunatoa hiyo. Receivables, that is a current asset, and therefore it should have a debit balance. It should have a debit balance. Cash in hand, it is also a current asset. It should have a debit balance. Inventory, that is also a current asset. It should have a debit balance. Returns outwards. These ones, they mark a reduction of our purchases. And because purchases are expenses which are debited, so to put it, when you return outwards, they reduce our purchases, and therefore they should be credited. They should have credit balances. The opposite is true for returns inwards. Returns inwards, they reduce our sales. These are customers who have returned back to us. And because sales are credited, then these ones must be debit balances. These must be debit balances. Ordinary share capital, that goes without saying, it is a credit balance. Preference share capital, likewise, a credit balance. Long-term debt, that's a non-current liability, a credit balance. Sales, that is an income, and therefore it should be a credit balance. Purchases, as I've already said, is a type of an expense and should be a debit balance. It should be a debit balance. Bank overdraft, that is part of cash and cash equivalents at the current liabilities, and therefore it should be a credit balance. Discounts received, that's an income, and therefore being an income, it should be a credit balance. Discounts allowed, that's an expense. When we give our customers a discount, that's a business expense, and expenses have debit balances. Building at cost, that is a non-current asset, and we know assets have debit balances. Heavy machinery, the same. That is also an asset. It should have a debit balance. Accumulated depreciation, it serves to reduce the cost of the asset. So it must then be a credit balance. The same thing with maybe what I could do is I could wrap these ones so that they don't appear like they are interfering with our mpaka maybe hapa 185. I can wrap that text namna hiyo so that they don't appear to interfere. Okay. So I was here for the depreciation, and I've said depreciation serves to reduce, so it should be credit. The same thing here. Audit fees, that's an expense, and expenses have a debit balance. Nani mwingine? Admin, the same, expenses, debit balances. Advertising expenses, the same, debit balances. Bad debts written off, that's an expense, debit balance. allowance for doubtful debts. Now, an allowance for doubtful debts, it serves to reduce the receivables. So that is supposed to be a credit balance. Retained profit. Now, retained profit is an income, and that should be a credit balance. So we can now get to establish the sum. So tutaanzia hapa, tuteremke nayo mpaka wapi? Mpaka hapa. We enter, then we drag here. Yeah. So you can see our trial balance has balanced. Our trial balance has balanced. So if the trial balance has balanced, what next? Let me undo that. We now must start responding to the additional information. We start responding to the additional information. We start responding to the additional information. To the additional information. Just a minute. Okay. Sorry for that. So we continue now. Additional information number 1 is that 1st of December, account receivable balance included 250 due from a customer who had been declared bankrupt. Yeah. So when a customer has been declared bankrupt, what that means is that we will not receive that money. It's a bad debt. So we are supposed to debit the bad debts account and credit the receivables so that we reduce them. So let's come down here. We look for our receivables. Receivables are here. So these receivables, we should reduce them by 250. We should reduce them by 250 because that guy has been declared bankrupt. Then we go down and look for the bad debts. Bad debts, we should increase them. This one. By debiting. So we debit there. That is what should happen. So you debit the bad debts account, you credit the receivables account. Okay. We are also told while accounts payable was found to have been overstated by 150. Now, an accounts payable arose because we purchased on credit. That's why or when an accounts payable arose or came about. So if it was overstated by 150, we must reduce our purchases by 150, and that will be done by crediting the purchases account. And we must also reduce our liability of payables, and that will be done by debiting the payables. So we will come down here, and I don't know whether this one I should have picked it. It's always good to keep the trail. I've been advising you that this way. That's how we should do it. At least when we type the first one, the second one, we should be able to show where it has come from. So we already have said that the payables needs to be reduced. The payables need to be reduced by 250. Is it 250? They need to be reduced by 150. So we debit here 150, sorry. It is here, the payables. Hii Excel yangu imeanza kuleta maneno. Aha, before it comes back, let's go for purchases. So purchases, we are reducing them. Purchases, we credit them by 150. Then we come here to where we have the payables. So we say equals. We are reducing them by this 150. Okay. The next information we are told, the allowance for doubtful debts is to be adjusted to 3% of accounts receivables. Is that fast? So first of all, we need to know what is the receivables. So itabidi tukuja hapa, these receivables, we complete them. What will happen is that there will be a debit balance of this, you less this. That will be the receivables after we make these adjustments. So now we are told we need to check or to adjust this. So we can come down here. We do not know how many lines we shall need for allowance. Tunaweza acha like 13. Tukuja hapa kwa 20. 120. We do our workings there. We can do our working. So workings. Do our working there. So working 1. So this is allowance. Allowance for bad debts. The allowance for bad debts. Now the balance carried down. The balance carried down should be equal to, we are told 3%. So 0.03 times, you multiply by this amount that you have gotten here, this one. 0.03, that's what they are telling us. It should be adjusted to 3%. It should be adjusted to 3%. So if we are adjusting to 3%, when you press enter in our figures here, this is what you get, the balance carried down. Now you need to compare this. If you remember you are accounting, you need to compare this with the balance brought down. With the balance brought down. With the balance brought down. So the balance brought down, utaenda in our trial balance, where we have the allowance for doubtful debts. Ndio hii. This one, 300. This is the one that was brought down. So when you compare this, you can see what has happened is that there is an increase. So increase. So the increase, and this increase will now go to the income statement. It will go to the income statement. And it's going to go to the income statement as an expense. It's going to go to the income statement as an expense. It's going to go to the income statement as an expense. So this increase will be equal to this minus, sasa hiyo inakataa, so nitasema ni C 123 na enter. So this one I can even give it something like that. So now that this is an increase, it's an expense. So how are we going to do it? We shall debit the income statement, but now we do not have it. And credit the allowance for bad debts. So tutakuja hapa, because we don't have the income statement, tutakuja hapa tuseme increase in allowance for doubtful debts. Yeah, increase. You don't have to use the same font. It's only that myself, I prefer being very specific. So now this one will be adjusted here. It's an adjustment. So we shall debit it here, this one. And then we come and credit it here kwa this one. So that when we have debited here and credited here, the allowance for doubtful debts will come here as this 300 plus this one, the increase. Yeah. So this 822 ndio tumepata hapa. So you can tell whoever is following your work that this one is working one. That's where we have gotten it from. Haya. The next one is that 1st of December 2023, there were prepayments of 50 and 75,000 towards administrative and advertisements expenses respectively. Okay. So when we have prepayments, what that means, we have an asset and then those expenses should be reduced. So we are going to have prepaid administrative expenses. We will also have prepaid advertisement expenses. Yeah, so when you have a prepayment, we will debit this because it's an asset and credit the respective expenses so that we reduce them. Sasa tukuje hapa. For the what? For the admin, it is 50. Advertisement is 75. So we are debiting here. This is 50. And this other one is 75. That way. Or I can do away with the decimals. Naona hizi zingine hazina decimals. So let me do away with decimals. Okay, good. Let me do away with the decimals. So, this one that we have debited, we must come and credit here. Coadmin equals this one. And this one, co-advertisement. Yeah. And the effect is that these ones, when we credit them in the trial balance here, they adjusted, they should be reduced. So hapa, the admin expense, we should reduce. So this 4,700, we reduce by this prepayment. We reduce by this prepayment to have it that way. And the same thing, this advertisement, we reduce by this. Yeah. And these ones now will also be here as prepayment. Even this one will also be there. So hizo tumemaliza. Let's go to the next one. We are also told that for the same period, there was an accrued amount of 120,000 towards audit. So audit fee, sidhani niliona audit fees. Oh, iko, it is here. So if it was accrued, we need to increase it here. We need to debit and then recognize that as a liability. So tutakibia hapa, we say accrued audit expense. Accrued audit expense, we credit it here. We are told the amount that was accrued is 120. And because we have said this is a liability, we can just bring it here to the end of it there. It's a liability, tukwe tumemaliza hapo. Haya, then we come and debit the audit here. We increase it. We increase it by this amount. So that when it will be time now to prepare the income statement, these audit fees will be equal to this plus this. The font here is different. So once again, let me adjust the fonts. To be 12. Yeah. Okay. So that is adjusted. Tuko hapa. The company paid the due interest on long-term debt on 7th. So if they are paying on 7th, that means it was accrued. It was accrued. So let's see whether it was even, first of all, recognized. Their own interest. Their own interest. I cannot see it. It was not even recognized. So tutakuja hapa, we talk of their own interest expense. Then we have the accrued. Loan interest expense. We can just have a working here. We don't have necessary to take it down there. So this being an expense, we need to debit. We come here and say equals. We come here and check our loan. Our loan is 9%. This one. So we are going to say 0.09 times this amount. This one here. 0.09 times that. So that is their own expense. And then, because it was not paid, we accrue it as a liability here. And then, in the adjusted trial balance, this liability will come there. And then this expense will be debited here. So their own interest, we have computed 9% of the amount. Kareta hapa. Yeah. Haya. The next thing is what? The next thing is depreciation is provided as follows. So there is building 5% on cost and heavy machinery 10% on reducing balance. Okay, so let's come and see how much is the... We don't have depreciation expense. We only have the accumulated depreciation. So I will come here and say depreciation for the year. Depreciation expense for the year. Depreciation expense for the year. We have tumeambiwa ni ya nini na nini? Building and heavy machinery. So we have building and then heavy machinery. So what I shall do is I hapa ni songeze 2 3. Tai niweke hapo 1 2 3. So this one, they are expenses. So I don't have to also do the working. I can work it here. Niseme equals. I got to where I'm told about the depreciation. I'm told it is 5% on the cost. So 0.05. That's the 5%. Times the cost. The cost of the buildings. Building at cost. DOE. That one. So 0.05 times the cost of the building. This one. So that is the depreciation. And this one, at the end of the day, it should be a debit expense here. And then it should go to increase it should go to increase the provision for depreciation of buildings. So this debit here should have a corresponding credit here. This one for buildings. So equals this one. Should have a corresponding credit hapa. And then the final figure will be this plus this. The one we began with plus the one for this year. You enter, that is the new balance. Let's do the same thing with heavy machinery. Heavy machinery, we say equals. We go up here. We are told it is 10% on reducing balance. So it is 0.1 times, open the brackets. Open the brackets. Let's go look for the net book value. So net book value on heavy machinery, you get the cost, the original cost, ndio hii. You minus the accumulated depreciation of the heavy machinery, this one. So I'm saying it is 10% of the cost, the original cost here, minus the accumulated depreciation. You press enter. When you press enter, that's the figure you get. When you press enter, that is the figure you get. Now, this figure, as we have said, should be debited here. And then the corresponding credit should come here. Here. In the accumulated. So equals this 820. And then you add it here. Equals this plus this. Okay, so tumemalizana na depreciation. Aya, let us go now for the next additional information where we are told the company annual general meeting resolved that preference dividend should be paid. So let's go look for preference dividend. So when you're told preference dividend should be paid, you are supposed to recognize it. You are supposed to recognize it as an expense, and let me add a few more. Higher. So dividends declared. So when dividends are declared, we have the preference and we have the ordinary shares. And you know, the AGM is held at the end of the year. So we don't pay immediately. So accrued dividend. dividends. So once again, we have the preference. I can add preference shares and then ordinary shares. Niongeze hapa preference shares. Yeah. So hii inaweza weka down kidogo 1 2 3. Even this one 1 2 3. The same case here 1 2 3. Even here 1 2 3. Yeah. So sasa, let's compute the dividends. First of all, these are expenses, so we need to debit them here. Equals, we will go and look for our preference shares. You see, preference shares, they are 10%. So it will be 0.1 times the amount of the preference shares, the nominal value. This one. That one. 10%, this 10% of this amount here. That gives you the preference dividends. And because you have said it's an expense, you need to bring it here to the adjusted. Then this debit here, it needs to be credited here. We need to credit it here because the liability is accrued. And we also credit it here. So we have recognized it here as an expense and a liability. The same case here in the adjusted trial balance. The adjusted trial balance. Let us now go to ordinary shares. So for the ordinary shares, the meeting approved 11%, so 0.11 times. Obviously, again, they are based on the par value of the ordinary shares. So unateremuka hapa chini, you get that the ordinary shares were valued at 12,000. So it is the 11% that was declared at the AGM. You multiply by the nominal value of the ordinary shares. Once again, this is an expense that we have debited, so we come here and debit as well. It's an expense that we have debited. But this one, we have not paid again, so we recognize it as a liability. That way, and even here, we have not paid. We need to recognize it as a liability. We need to recognize it as a liability. The company also approved that 3 million be transferred to general reserves. Okay, so that is part of if we had prepared the income statement, we should less that from the retained profits or the profits of the year. But now that we have not prepared, we are going to prepare an account called profit appropriations account. And then sidhani we have general reserves. Tuangalie hapa kuna kina ordinary shares. Inastahili kuwa hapo. Hakuna. So we create an account called general reserves. General reserves. So what will happen is that we will debit the appropriations account by 3,000 and credit the reserves. And credit the reserves by the same 3,000, the general reserves. And this entry must then be completed here. These are debits. We bring this 3,000. And these are credits. We bring it here. So the profits appropriations account or section of the income statement. Sasa with that, we maintain gross profit. This one has no effect on our entries, even number 8. So with that, as usual, now we go checking item by item, ensuring that it is complete as it should be. So we start here. Accounts payable, they were adjusted here, but we never brought them to where they belong. So we make that. So this 4,500, we are minusing because it had been overstated. So that is the correct value of the accounts payable. The receivables, here we started with this. There was an adjustment tukapeleka mwisho. Cash in hand, we started with 3,000. No adjustment. So we are supposed to bring the 3,000 here as a current asset. Higher. The closing inventory. No, not closing. This is opening. It was not adjusted, so we bring it here. Returns outwards, they were not adjusted, so we take them here. Returns inwards, they were not adjusted, so we just bring them here the way they are. Ordinary share capital, no adjustments. No adjustments, so we bring it here exactly the same way it is. Higher. Preference share capital, no adjustment, so we bring it here. Long-term debt, no adjustment, so we also bring it here. Sales, no adjustment, so we bring them here. Purchases, they had an adjustment which served to reduce them because they were overstated. So we are supposed to bring it here as this minus this credit. So that's the correct amount for purchases. Bank overdraft, it was not mentioned in the additional information, so we just take it as it was at the beginning. The same case with discounts received. There was no mention, so it remains. Discounts allowed, no mention, so it remains as an expense. Building at cost, no mention, so it comes in here as a fixed asset. The same case with the machinery here. Accumulated, we adjusted here and brought to the end. Accumulated depreciation for the heavy machinery, where there was an adjustment, which we already have accounted for here. Audit fee, adjustment was there. We already have adjusted. The same with admin, the same with advertisement. Bad debts, there was an adjustment, but we have not responded to that. So this is an expense, and it is supposed to increase by this debit. So it should be equal to this 150 plus this 250. Higher allowance for doubtful debts. That one we already have adjusted. Retained profits, no mention, so we bring it here. Increase in allowance for doubtful debts. There was an adjustment, so we bring it here. It's an expense. The prepayment, that one is adjusted mpaka mwisho. Prepaid, mention and adjusted. Accrued audit, hiyo imefika mwisho. Loan interest, we also have taken it to the end. Accrued loan interest expense, we also have gone to the end. Depreciation expense for the year for buildings, we have gone to the end. Machinery, the same. Dividend for the preference, the same. Ordinary shares, the same. Preference shares, the same. Accrued dividends, ordinary, the same. We have gone to the end. Even here, we have gone to the end. Even this one. So let's now check whether it will balance. So I will just come here and seek to insert. I can insert 2 rows so that I have the total. Total will be equal to the sum. Can as well start here, no problem. Going upwards. Going upwards. Up to here. Excel inajipanga yenyewe. Naona inaanza na 83. Then I close the brackets. And I press enter. These figures, I need them to be bold. This one, I need to give it a double underline. So I autofill up to here. And you can see my figures have balanced cent to cent. These ones are good. These ones are good. These ones are good. Yeah. So this one was a little bit better than the others that we have been doing, because haikuwa na income statement na statement of financial position. So it's a little bit better sababu haina financial statement. So we have done 6 columns and we are used to 8. Okay. So thank you very much. I hope in our next lesson, we will look at question number 25. Proceed from there. So if you have not yet subscribed to my channel, make sure you subscribe. If you are new to this class, you can consider joining us or recommending other persons to join us for the classes that are beginning next month. But for those who are doing these exams, we are wishing you the very best in your exams. Thank you very much. Keep it here at Church and Consultant.